bond markets.
US Treasury bonds.
The bond market.
Bond market.
The bond market.
The bond market right now is beautiful.
There's absolutely no doubt that the market has been very volatile these last few weeks, given the uncertainty in tariff policy. After April 2nd, Trump's so-called Liberation Day, the markets took a plunge, with the S&P 500 and the Nasdaq taking hits of over 15%. Even with the stock market sell-off, Trump came out and said he was not concerned and he was standing firm on his reciprocal tariffs. This did not last long because a week later, Trump announced a 90-day pause on all trading partners except for China, who now faces a combined 145% tariff rate on some imports to the US. So if the stock market being in a free fall did not make Trump blink and back down from his extreme tariff policy, then what did? The answer is the bond market. You see, the bond market is the reason why people are saying Trump is playing chess. The thought is that by Trump coming out with such an extreme tariff policy and creating uncertainty with trading partners, investors would sell out of stocks and buy less riskier assets such as government bonds. When investors buy bonds, the yields on those bonds come down. When yields on bonds come down, that means the government is now able to borrow money at lower interest rates and refinance their existing debt at lower rates, effectively cutting down the interest that they need to pay in government debt. And if we take a look at the government spending, we see that interest payments makes up a big part of the budget. Now, did this chess move from Trump work? Well, let's take a look at the long-term US Treasuries. The 10-year US Treasury spiked from about 4% on April 3rd to 4.5% on April 9th, days after Liberation Day. And 30-year US Treasuries rallied from about 4.4% to 4.9% in that same period. A rise in long-term US Treasury debt has an effect on the economy. The longer that the yields are high, the longer that it is for Americans and the government to borrow money at really high costs. So as you can see, there's an incentive to keep long-term US Treasuries at a relatively low interest rate, especially since the government runs on a deficit, meaning that they spend more money every single year than what they bring in. So it's really no surprise that Trump came out after this rise in yields to announce a 90-day pause on tariffs and a baseline reciprocal tariff rate of 10%, except for China. Now, this rise in yields means that there's a sell-off in US government bonds. And I'm sure you guys have seen that there's a lot of speculation as to who's behind all this, with articles and videos coming out saying that it could be China. But the reality is that we don't really know. And it could well be a mixture of a bunch of different things. Yes, China is the second largest foreign owner of US Treasuries, but they've been actually reducing their US Treasury exposure for a while now. Another theory is that this spike in yields is due to over-leveraged bond investors that need to sell their bonds to reduce risk. Regardless of the reasons, this uncommon situation of both stocks and bonds falling in price needed to be addressed, and that is why we saw a response from the administration, whether they want to admit it or not, leading to the pause in tariffs and the single largest one-day gain in the market since 2008. Now, all this talk about a rise in bond yields leads me to another point that I want to make. And it is that during all this time, gold prices have actually been soaring, with gold futures being up 24% year to date and hitting a high of $3,400 per ounce. This is drastically different from Bitcoin and other cryptocurrencies that, according to enthusiasts, are the digital version of gold. So all this turmoil with stocks going down, bonds going down, the dollar weakening, we see that big money is really not turning to cryptocurrencies as safe haven as compared to gold. So it goes to show that cryptocurrencies really do only thrive in euphoric markets and where people have more discretionary income that they could throw into speculative markets such as cryptocurrencies. In the end, the best strategy is to continue dollar cost averaging into the market or into individual companies that you have already studied. As we have seen, this market is driven by sentiment. And in sentiment-driven markets, it's really hard to time the bottom because things can change very quickly. So as for what I'm doing during all this stress is I continue to buy every single week the same companies that I've already researched. And every dip we get is another opportunity for me to load up on companies that I believe are well positioned to weather this storm. So that's going to be it for this episode. Hasta la próxima, mi gente.